Hi there, this is Jill from Financial Clarity Limited. Last week I talked to you about periodic savings and how you can save throughout the year and to provide income or money available anyway at the end of the year. As somebody commented on Facebook, you know, it's rather like hamster or any other kind of Christmas a savings account. But the difference is this remains under your control and it can be used for other things. And I was delighted to get that comment, and so please don't hesitate to put questions or reservations you have about what I say. Today I thought I would briefly talk to you about debt consolidation. Again, it's one of the most common questions I get asked. People often come, should wrap it up into their mortgage, consolidate it under one personal loan, and you know, there are a variety of ways of doing that. You know, you can go to another bank, open up another account, transfer all of your credit card debt to there, and you know, start it off as a new debt. The positive side of debt consolidation is it's one payment per month or per week, however you want to structure it, and that makes it much simpler and much easier, means you're unlikely to miss payments, and often you can get this consolidated at a much lower interest rate. Interest rates on credit cards are sitting around the 19 to 20%, and if, as the Reserve Bank is talking, interest rates go up, that will be one of the first places you'll find it, is on your credit card debt. So, you know, with a personal loan you can often drop your interest rate down to single figures or much lower, two figures. So, you know, those are both the positive things. However, there is a big negative risk as well, and that is that if you consolidate your loan before you've actually stopped debting, if you consolidate it but carry on using your credit cards, there's huge risk. For one thing, the thing that happens when you consolidate it is the debt comes off your credit cards, and suddenly you've got, you know, 1,000, 5,000 or whatever spare to spend as you think. And if you do that, the result is that by now you've got, you know, maybe your mortgage, the personal loan, and then you can still have credit card debt. So really all you've done is add to your total debt burden. So if you're at a point where you're no longer using your credit card, and that isn't just because you haven't got any room to use it anymore, but rather that you're now living within your means using cash or debit cards, and you no longer really need the credit card, then I think it's a great idea, because you know, it does reduce the interest and therefore the total cost of the debt. So just to recap, the positives are that you consolidate it all in one loan, which makes it much simpler to handle. The second thing is that you'll often get your loan at a much lower interest rate. But on the negative side, if you continue to use your credit cards, all you've really done is add to your total debt burden. So the first step is stop using your credit cards and manage to live within your means. And by all means, once you've done that, then consolidating your loan is a very good idea and one that I would support. Okay, talk to you next week.